Two drivers, identical cars, same zip code. One pays $89 a month, the other $267. The difference isn't luck. The standard story is simple. Insurance companies charge based on risk. Younger drivers cost more, bad driving records cost more, urban areas cost more. And here's the trick, that's all technically true, but it's also the surface of a much deeper system that most people never see, and it's where the real money lies. Start with age. A 19-year-old pays roughly triple what a 45-year-old pays for the same coverage. Why? Historical loss data. Insurers have decades of claims records showing that teenage drivers file more collision claims per mile driven than any other age group. That's not judgment, it's actuarial math. The numbers don't lie, and neither do the premiums. But here's where it gets complicated. Location matters enormously, not just because of traffic density, but because of state regulation. Each state has its own insurance commission. California's Proposition 103 banned gender-based pricing and capped rate increases. New York's rates are controlled differently. Texas's are barely controlled at all. Same driver, different state, wildly different price. And here's the trick, the insurer isn't being unfair. They're following the law. Then comes credit score. Insurers discovered something counterintuitive. People with lower credit scores file more claims. Whether that's causation or correlation, the data held. So your financial behavior, something that has nothing to do with driving, now determines your insurance cost. It's legal in most states. It's also why identical drivers can have $100+ monthly differences. Claim history is the heavyweight factor. One at-fault accident, expect a 40% increase for 3 to 5 years. 2 accidents, you're looking at 60-80% more. But here's the real money. Insurers use predictive modeling now. They don't just look at what you've done. They model what you're likely to do based on thousands of variables: your commute distance, how often you drive at night, whether you've had speeding tickets, even your zip codes, weather patterns. The regulatory framework ties it all together. Insurance companies must justify their rates to state regulators. They submit actuarial studies showing why they charge what they do. Those studies are public record in many states. And here's the trick, the system works both ways. It protects you from arbitrary pricing, but it also locks in data-driven discrimination that's perfectly legal because it's mathematically defensible. So when you get quoted $267 while your friend pays $89, you're not seeing bias. You're seeing the collision of decades of lost data, state-by-state legal frameworks, credit reporting systems, and algorithmic modeling all stacked on top of each other. Each layer is defensible. Together, they create a pricing structure that feels random but is actually the opposite. It's hyper-rational, and that's exactly why it feels so unfair. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe. We decode the financial systems that quietly control your costs every month. This video is for educational and informational purposes only and is not financial advice. Always do your own research.